It's 5 years now that financial markets and policymakers have been living in a more or less continual state of anxiety. It was poor lending practices into the US mortgage market that was the root of at least the initial problems in this episode. But pretty early on it became apparent that European banks also had serious difficulties. That was because of their exposure to securities of doubtful quality, particularly American ones, high leverage, and the need to fund US dollar denominated positions on a short-term basis. And it was in August of 2007 really that the crisis proper really began, when those acute funding difficulties for European banks suddenly became clear in financial markets. Well, 5 years on, and American banks have made a lot of progress in working through their asset quality problems and their capital deficiencies. At times that process was not pretty, but the US system is in a much better place today as a result. And indeed, US taxpayers have even earned a positive return on their investments in American banks made at the peak of the crisis. In Europe, progress has been rather slower. There are a number of reasons for that, not least the sheer complexity of coordinating the process of evaluating and strengthening balance sheets in so many countries, where the national capacities to respond and to contribute are so different, and all of that within the strictures of a currency union. Suffice to say that that's a very complex set of problems, and there are negative feedback loops between the economy shrinking, that affecting bank asset quality, and affecting fiscal solvency, which then feeds back into the economy and so on. So it's no surprise that probably for the past year at least, the news has been dominated, it seems, by the ebb and flow of anxiety over things like will the Troika approve the next round of funding for Greece? Will a German constitutional court strike down the German government's efforts to assist the region? Will the populace in some country or other, under great stress, take to the streets and reach the end of their tolerance for austerity, and so on? So there's event risk, so to speak, in Europe almost weekly. That is the European drama. Unfortunately, my sense is that it's set to continue like that for quite some time. It's true that over recent months financial sentiment has improved from despair to mere gloom as a result of a number of important steps that were taken and commitments that have been made. And it's right, actually, that sentiment has improved, because that recognises the determination of the Europeans to save the euro, and we shouldn't underestimate the strength of that determination. But there is so much more to do, and it will take a considerable time to do it. So while good progress is being made, we will not anytime soon, I don't think, see a point at which the euro problems can be seen as now in the past. I think that's going to take quite a long time. And so the world and all of us will have to live with euro area anxiety as a normal state of affairs for some time. In the meantime, the US economy has continued its slow healing. The US housing sector, I think it's increasingly clear, has finally turned, and that's been a major headwind for the US until now. The election is now passed, and with that the so-called fiscal cliff has rapidly come into focus. This is a new source of event risk, and we will read a lot about this in the next 6 or 7 weeks. But if one is prepared to assume that the US political process won't ultimately, in the end, actually preside over a massive unintended fiscal contraction at the beginning of next year, then, if you're prepared to assume that, the risks to the US economy probably look more balanced at the moment than they have for a while. That is to say, an upside surprise would be as likely as a downside one, and it's probably been a while since one could have said that. It would be fascinating if, in another year, you're here at another dinner like this, and you find yourselves looking back at a US economy that had outperformed expectations. There is, of course, still a critical need for the United States to craft a measured and credible path back to fiscal sustainability. That particular drama, I suspect, may last just about as long as the European one. It is appropriate, though, having said those things, to turn our gaze to our own part of the world, especially in the current period of discussion on the Asian century. 2 years ago, when I last spoke at this gathering, I showed a chart. And what I'd like to do is to go back to that graph. Those of you who are here may remember it. This is Australia's terms of trade since 1870. And we have annual data and a 5-year moving average of that annual data. Well, I can update that chart for you tonight. And the updated version looks like that. So the terms of trade, having already risen a fair bit, one might say, or we'd say not inconsiderably, being central bankers, that's probably what we'd say, has in fact gone even higher. They have started to come down from the peak, but as it turns out, these are annual data, but the quarterly data for the September quarter, which is the latest quarter for which we have the figures, is in fact 7% higher in that quarter than the quarterly number which was embodied in the forecast I had 2 years ago. This event is sufficiently unusual, in fact, that we can add a little tweak to this chart. Instead of just a 5-year centred moving average, we can have a decade-long one. And that's what this does. And what that does is it kind of flattens down some of those previous episodes that didn't last so long. And it emphasises not so much how high the terms of trade have gone this time, but how long they're there. It's an 11-centre moving average for the kind of technical people among you, because we want to centre it, so you need an odd number of years in the moving average, and that's why I chose 11, but you can think of that as a decade average. To compute that, of course, we have to make a 5-year ahead assumption. Well, we forecast about 3 years out, and we've, sort of added a little bit to that. Basically assuming that commodity prices fall a bit faster than is implied by the forecasts of private analysts. Even if that occurs, what this is telling you is that over a 10-year period, by the time this is over, the terms of trade will have been 50% higher for 10 years on average than they were for the preceding century on average. That, ladies and gentlemen, is a big deal. I could make a more pessimistic, that's the actual assumption we've made. If we assume this one, which is twice as big a fall, what that does to the 10-year moving average is that. So it's a big deal. It is easily the largest and most persistent terms of trade event for a very long time, quite possibly since European settlement of Australia. That's why we've been banging on about it for so long. It's a fundamental realignment of relative prices in the global economy. It affects the structure of all economies, including this one. On the whole, it's advantageous to Australia because a rise in the terms of trade is a rise in real income. And that's why we've talked about it so much. Still, it's time to say, and we've been saying for a while, the terms of trade have peaked. They peaked a year ago. By the end of this year, they probably will have fallen by about 15% from the peak. Further declines over time are likely. So while a high level of the terms of trade will continue to hold up the level of our national income, we can no longer expect that a rising terms of trade will be adding to growth in our living standards. We're entering a new phase. Now, that's not really at this point so much because of the so-called end of the mining boom. As a matter of fact, talk of the end of the mining boom is a bit overhyped. The boom isn't ending so much as just evolving more or less in a way that you might expect these events to do. Thoughtful commentators have already pointed out a number of times that there are in fact three phases to the mining boom. The first phase is the price part, and that's what this is showing. The rise in natural resource prices in fact began as far back as about 2004. The peak in prices, as I've said, was a year ago, a bit more than that now. And in fact, the Reserve Bank has been saying in our monthly statements after each board meeting since October of last year that prices had declined. That said, relative prices for natural resources, which is what our terms of trade is, are still high. At this point, just where the blue is here, well actually these are annual data. If I put the quarterly data on, we are back down now to the peak of 2008, which was of course a 50-year high. So they're still high. So that's the prices. The prices have peaked, they've come down, they will fall further. The second phase of the boom, of course, is the rise in physical investment in the resource sector to take advantage of the fact that prices are high. That's aimed at taking advantage of high demand and hopefully pretty high prices, even if not peak prices, into the future. The peak in the investment build-up is in fact still ahead of us. It's not far ahead now. We've felt for some time that the peak would likely be in 2013 or 2014, and that expectation seems to be firming up. The level of the peak is probably going to be a bit lower now than we thought 6 or 9 months ago. And that's in view of the fact that prices have come down for commodities and they've been more variable, and boards of directors of resource companies, not to mention their lenders, have become more conservative, understandably. That's a material revision to the outlook in a near-term sense, but it's worth putting this into perspective. For 50 years, mining investment was between 1 and 2% of GDP, with occasional peaks at 3%. You can see a peak there in the late 60s, another one with the ill-fated resources boom of the early 80s. Peaks were 3%. Right now, what we're uncertain about is whether this boom is going to peak at 9% or only 8%. What isn't uncertain is that either of those is a very, very large number by any historical standard. So this also is a big deal. It's worth observing as well that in any episode like this, there is always going to come a point when some potential projects conceived at the time when prices are at their highest and the sky looks blue, and just before costs of doing projects really start to escalate, a number of projects conceived at that moment are going to end up having to be shelved. Actually, if projects rely on extremes of pricing, it's probably better that they be shelved before they get too far. And that's one of the things that we're starting to see come onto the horizon now. I think the other general thing to say is that some important parts of the resources sector have now reached a point where the costs of further expansion in capacity in Australia, relative to the costs of doing it elsewhere in the world, are a much more important factor in investment decisions than they might have been a couple of years ago. So that's the second phase of the boom. The third phase, which is really just getting started, is when the capacity to extract and export the resources is actually used. That's begun, but much of it lies ahead, especially in the case of a commodity like, say, natural gas. The main uncertainty here really is over what the prices will be that will be achieved for those resources as additional supply, and not only Australian supply, but supply elsewhere as well, comes on stream. Well, that uncertainty is there. It's always been there and always will be, part and parcel of the business of extracting natural resources. Perhaps what people have found a little unnerving over the past year is that as the prospect of rising supply gets closer and prices have come down, albeit remaining pretty high in most cases, we've also seen the Chinese economy in transition to slower growth. Now, it was inevitable, actually, that China would slow to some extent from the very rapid pace seen for much of the past decade. The signs that it needed to slow were quite evident. Rising inflation, an incipient bubble, if not an actual bubble, in the property sector, doubts about the process of credit growth and credit management, and so on. So there had to be a slowing. But just how big a slowing was occurring? That was the question. That's the question really that most people have been grappling with for this year or more, probably for the last 12 months or so. My assessment is that the slowdown has been more material than had been expected a year ago, but not disastrously so. There are some signs that the moderation might have run its course now, actually, though that's a very preliminary assessment and further data would be needed before such a view could be offered with confidence. So the Chinese economy has not crashed, but neither is it likely to return to the sorts of double-digit percentage rates of growth in GDP and the 15% odd rates of growth for industrial production that we saw for quite a few years. People expecting that to resume are going to, I think, be disappointed. These trends are entirely consistent with two propositions which we have advanced on a number of occasions over recent years. The first is that China's economy would have and does have an important and increasing weight in the regional and global economies. China's real GDP, as measured for to the extent we can accept those data, and they're the only data there are, its real GDP is almost 3 times what it was a decade ago. It follows from that even modest growth in China today carries considerably more weight for the global economy than rapid growth might have 10 years ago. If China grows by only 7% in 2013, that will add more to global GDP than 10% growth did in China 10 years earlier in 2003. 10 years ago, that 10% growth added about 3/4 of a percentage point to global GDP. 7% growth next year, if that occurred, would add a full percentage point to global GDP. The second proposition that we've held is that China, like every other economy, has a business cycle. It's affected by what happens elsewhere in the world, and it has been affected over the past year by the slowing in the advanced countries. It's affected by its own internal dynamics, including by what its policymakers decide, and there's no doubt that a good part of the Chinese slowdown was intentional on the part of the policymakers there for good reason. Swings in China's performance are increasingly affecting Australia's economy and that of our region and the world. In fact, the focus on the monthly data reports from China these days in our business press, in addition to the focus on things like the leadership transition that we've just seen, is quite striking. The Chinese Purchasing Managers Index, a measure of manufacturing activity, the Chinese version of that is at least as keenly awaited, I would say, as the US version is these days. The US version It's a US PMI, it's actually called ISM, and I can remember when it used to be called NAPM, so there it is. But the Chinese version of that sort of thing, I'd say is probably more market moving over the past year for us than the US one, and there is some tentative evidence, it's only tentative now, starting to emerge that Chinese data surprises have become increasingly influential in driving the exchange rate and the share market.